Hey there, and welcome to This Explainer. Think of me as your personal financial mentor today. We are going to completely demystify investing, cut through all that annoying financial jargon, and build your actionable wealth roadmap for 2026. If you've been sitting on the sidelines, maybe feeling a little overwhelmed by market volatility or those complex news headlines, well, you're in exactly the right place. We're going to strip away the noise and focus purely on what actually works. So here is our syllabus for today. Number 1, the Wealth Building Foundation. 2, dangerous mistakes to avoid. 3, strategy and risk reduction. 4, investment accounts explained. 5, fractional shares and funds. And finally, 6, your step-by-step playbook. We're moving logically from that foundational mindset right down to the exact buttons you need to click to get started. Let's kick things off with a pretty simple question. Why do some people achieve true, lasting financial freedom while others just constantly lose their money to market swings and bad timing? Honestly, successful investing isn't about having a crystal ball, and you definitely don't need a genius IQ. It's really just about understanding a few fundamental rules, dodging emotional traps, and, best of all, letting time do the heavy lifting for you. All right, let's jump right into section 1, the Wealth Building Foundation. Now check this out. This number perfectly illustrates the sheer magic of compound growth. If you take a single $1,000 bill and invest it at an average 8% return in a low-fee S&P 500 index fund like SPYM, which has a tiny 0.02% expense ratio, it compounds to over $10,000 in 30 years. You literally didn't add another dime. The money simply made money, and then those returns made their own returns. It's this beautiful exponential curve. The absolutely crucial takeaway here is keeping your fees incredibly low, because higher fee robo-advisors or managed funds, they will literally eat thousands of dollars of your potential wealth over that exact same timeline. But, math is really only half the battle. As this awesome insight from AQ Fin captures, when markets become nervous, investors do not lose money on the exchange. They lose it in their thinking. It's so true. Your portfolio might dip during a turbulent market, sure, but you only lock in those losses if you panic and hit sell. Safety isn't about avoiding risk entirely. It's about building a robust portfolio that you can confidently hold on to when the headlines start looking scary. Discipline, not timing, is for sure your greatest asset. Which brings us to section 2, dangerous mistakes to avoid. As your mentor, I need you to actively avoid these 7 wealth-destroying psychological traps. Please, don't race the clock trying to time the market. Missing just a handful of the market's best days can absolutely cripple your annual returns. Don't fall into the emotional traps of fear and greed. And definitely don't get caught without an emergency cash buffer. A broken piggy bank means you might be forced to sell your investments at a major loss just to cover a real-life crisis, like a surprise medical bill. And finally, you've got to ensure your risk is balanced so a single bad day doesn't tip your whole portfolio into the red. Seriously, if you approach the stock market like pulling the lever on a Vegas slot machine, the house is eventually going to win. In fact, a staggering 95% of day traders lose money. 95%. But if you treat it more like planting a tree, researching strong company fundamentals for a 3 to 10 year partnership, you set yourself up for incredible success. You want to look under the hood at their cash flow, their competitive advantages, their stability. Investing is simply about owning a piece of a real, functioning business. Okay, moving on to section 3, strategy and risk reduction. So, how do we actually build robustness in a world driven by AI and complex geopolitics? One word, diversification. This means you don't bet the farm on a single hot stock. Instead, you spread your capital across different sectors, like real estate, manufacturing, tech, to act as a shock absorber. If regulatory or economic shifts hit just one area, your whole portfolio won't sink. Diversification is your shield against the unknown. A massive part of diversifying is balancing value stocks against growth stocks. Value stocks are your everyday essentials. Think Procter & Gamble or JP Morgan. They might seem, a bit boring, but they're stable companies that pay you cash dividends even during a recession. Growth stocks, on the flip side, reinvest their earnings for rapid, though often volatile, expansion. Mixing both, which you can often do just by buying a total market index fund, gives you this beautiful balance of stability and massive upside potential. Let's shift gears to section 4, investment accounts explained. Choosing the right account is just as crucial as choosing the right stock. A taxable brokerage account offers high liquidity, meaning you can pull your cash out whenever you want, but it taxes your capital gains. A Roth IRA, however, has pretty strict contribution limits, but it allows your investments to compound completely tax-free for retirement. So if you're investing for house down payment in 5 years, the taxable brokerage is your go-to tool. But if we're talking about building long-term generational wealth, the Roth IRA is arguably the most powerful wealth-building tool in existence. Every single dollar of profit inside it is totally shielded from taxes forever. Next up is Section 5, Fractional Shares and Funds. If you're feeling overwhelmed by high stock prices, I have great news. You do not need thousands of dollars to own a piece of the best companies on earth anymore. Fractional shares are an absolute game changer. They let you buy tiny slices of very expensive companies, ensuring every single dollar you deposit goes to work immediately. This makes it super easy to use a brilliant strategy called dollar cost averaging. That's where you consistently invest a set amount, say $50 every single Friday. It smooths out the bumps of market volatility over time and completely removes the stress of trying to time the market. Just take a look at the fractional percentages in this table. A mere $25 can instantly get you ownership in massive tech giants like Meta, Google, Microsoft, and Netflix. Even with Netflix trading well over $1,000 a share, your $25 buys you a 2.2% slice of a share. This completely destroys the old excuse that you just don't have enough money to start investing.
And finally, Section 6, your step-by-step playbook.
All right, it is time to execute. This is where theory becomes reality. Here is your direct, step-by-step roadmap for deploying your first $1,000. Step 1. Secure a 3 to 6 month cash buffer in a high-yield savings account so you're never forced to sell stocks just to pay for a flat tire. Step 2. Open a tax-advantaged Roth IRA with a major trusted broker. Step 3, select a broadly diversified, low-fee S&P 500 index fund, which instantly buys you a slice of the 500 largest U.S. companies all at once. And Step 4, execute a dollar-based market order with automatic dividend reinvestment turned on. That last part, the dividend reinvestment, or DRIP, is absolutely crucial. It means anytime those companies pay you a cash dividend, your broker automatically uses it to buy you more fractional shares, rapidly accelerating your compound growth entirely behind the scenes.
Remember, true wealth building is a waiting game. Staying consistent, tuning out the daily noise on the news, and letting compound growth do its job over decades, that is the ultimate key to success. Investing isn't a gamble if your timeline is long enough. As the experts at Charles Stanley point out, the longer you stay in the market, the higher your statistical probability of success becomes. Time is literally your greatest multiplier.
Like and subscribe.
The tools to invest are cheaper and more accessible today than ever before. You now have the playbook, the exact mechanical steps, and the disciplined mindset required to get your money working for you. The market is waiting, so the only question left to ask yourself is, are you ready to start building your wealth today, or are you going to let another year pass you by?